In today's video, I want to talk about a scenario that I will not go in and do a trade. If you look at Facebook, last week, Facebook was at 218, which is the all-time high for Facebook. And when the earnings announced, Facebook dropped 20% to around 175 area. And this is the risk that we have to take if we are trading stock as compared to QQQ or SPY. When you trade a stock, there is always such a scenario that the stock can drop 20% and caught you off guard, and there's nothing you can do about it. The index market can drop 20%, of course, but for the index market to drop 20% normally is over a few days, and that gives you enough time for you to analyze. A lot of people is caught off guard by Facebook because the previous day the Facebook is still going up, and then on the earnings day the Facebook just dropped 20% or dropped about $40, and that's quite a big move. But even if you are trading Facebook, it is not the end of the world. Let's just take a look. If you have traded Facebook before the drop, and let's assume that you go in at about this stage when the stochastic is oversold, which is about the 192 level. So if you sell a Facebook at 192, and because this one only have, I think, less than a month, and if you sell the Facebook into the following month, so you are selling a stage 1 nickel put about 40 or 45 days into expiry, I believe you can fetch about $7 or $8 for Facebook. Let's take a look for a 40 days option for Facebook at the money put option. How much is it worth? So we are looking at the 175, which is at the money, so that's about $6.30, or we round it up to $6. So assuming that you enter the Facebook at this stage at 192 and you sell $6, and assuming that on the expiry the Facebook is at 175, then of course you'll be losing money because you only collected $6 of premium. Then we will be entering into stage 2, and at stage 2 you'll be selling a call and a put, and assuming you can fetch another $6. So in total you are collecting $18 of premium at stage 2, and assuming that the market for Facebook did rebound, then you have collected $18 of premium. And how much would be your loss? Because from 192 to 175, that is $17 of premium that we are losing. But because we collected 3 rounds, the first time 192 put for $6, and then 175 call for 6, and 175 put for 6, so we collected $18 of premium, and the first put we are losing $17 of premium, so net we are still up $1. If we go into stage 2 and assuming the Facebook rebounds, of course if the Facebook continue to go down, then we will be entering into stage 3 where we will be selling 2 call. But by the time you are at stage 2, you have already collected $18 of premium. That is quite a lot. But if I don't have any position, and even if the stochastic is oversold, I won't enter Facebook at this point of time. The reason is very simple. If we look at the side-by-side comparison, and let me remove all the studies so you'll be much clean. And let's take a look at the ES, and for ES I want to remove away this. And then at the bottom we'll do a comparison with Facebook, and again remove all the studies so it'll be much cleaner. The index market is going up, but Facebook is coming down. This is a very dangerous situation. Even if Facebook is oversold, I won't enter Facebook at this point of time if I don't have a position. Of course, if I already have a existing position, then I'll manage from there. But if I'm going to enter a new position, then I won't choose Facebook at this point of time. In fact, at this point of time, I won't be doing this strategy because the index market is on the uptrend. So if you look at other stock is basically the same. It is on the uptrend. And the index market may be at the overbought situation. And if it is at an overbought situation, there's a chance that the index market may come down. Even if the index market were to come down 5%, what do you think of Facebook? Facebook will even drop even further. So I won't be entering Facebook at this point of time for this very simple reason. What we want to do is actually to wait for the index market at least to come down, even if it is not oversold. But the index market is down and the stock is at the oversold situation, then we want to enter this strategy. Because when that happens, then there's a good chance that the index market will go up and hopefully the stock will go up and we will make money on the trade. So basically at this point of time, I won't be entering a trade because the index market is up, and definitely I won't enter a trade on Facebook because index is up, stock is down. Fundamentally, Facebook is having problem at this point of time. Of course, I may be wrong. If you look at the internet, there's a lot of people saying that Facebook is a good buy at this point of time because it has just dropped $40. But it is anybody's call. So this is just my personal view. And if you have any question on this video, do let me know. Thank you.